Here's my stock that I've got for February, where Paul is now known as February. He's February on my calendar anyway. My stock is called Intercontinental Hotels Group because I wanted to talk about a UK stock. So what does it do? It franchises, important word that, we'll come back to that bit, franchises a bunch of hotels. You'll have heard of some of its brands and probably not others. You might have heard of Iberostar. I have. Best holiday I went on was there actually on one of those. Regent, Sixth Sense, Holiday Inn. Not the best holiday anyone's ever been into, that one, but they are what they are. Candlewood Suites and some other stuff as well. They have 880,000 rooms contained in their various hotels. 71% of these are franchised, and the way that works is they take 5 to 6% of the room revenue from guests while doing absolutely nothing. Proper dividend investing, this. They provide the branding and the network, and they appear on their site and search and so on. And as a result, people pitch up at their hotels, and Intercontinental takes 5 to 6% of the room revenue only. 28% of what they call managed, where they provide basically management. In exchange for that, they take between 1 and 3% of the total hotel revenue. So that includes stuff like food and bar and all that sort of thing as well. 1% of them they own outright, and they do all the work and keep all the profit, and they're busy getting rid of those because they seem like a lot of work. So, loads of red flags around this stock then. Let's start with where everyone's going to start. This thing has a PE ratio of 29. That's quite high for a hotel chain, I think. I haven't compared it to too many, but there are reasons why this might not worry you too much that build on a theme that you were talking about before, Steve. It's high compared to, say, Google, which when at the time I started writing this was trading at a PE of around 20. It might be lower, but let's stick with 20 for the moment. So CapEx is around 10% here of operating cash flow in this case, so close to EBITDA, but not quite the same thing. Google has around a 34% CapEx ratio at the moment, and this is a feature of franchising things. Franchising stuff means that you don't pick up all the costs associated with hotels. You don't have to pay the electricity bills. You don't have to maintain swimming pools. You don't really have to reinvest into them very much at all. You don't have to pay staff. So if you had $1 million coming through the doors at Intercontinental, it would become 900,000 in free cash flow. If it came in as, operating cash flow. And if you bought it at a 29 PE ratio, that would give you a 3.1% return. Same thing coming in at Google becomes 660 in free cash flow. Buy that at 20 times earnings gets you to 3.3. So it's slightly under the Google returns, but we'll come back to some thoughts there in a moment. Pre-pandemic, this was punching revenues along quite well as it added things into its network. It doesn't cost much to add things into its network, so its acquisition costs are pretty low, but it was pushing along nicely at sort of 17.5% revenue growth per year, which is all right, considering it doesn't really cost you a lot to do that, so most of it makes its way through to the bottom line, and it's still finding its way back a little bit from the pandemic, mostly due to demand stuff, not because, like an airline, it got into all kinds of trouble with operational leverage and had fuel costs to pay, doesn't have any fuel costs, had loads of staff costs, doesn't have any staff, well, has some staff, doesn't have that many staff, and everything else. So its debt went from $2.8 billion to $4.2 billion in total, and it's come back to 3.2 already. So it's most of the way back home again. Compare that to an airline, EasyJet, a stock we like talking about, underrated growth stock in the UK, according to some other people. Went from 1.9 billion, more than doubled to 4.4 billion, and has made its way back to 4.3 billion. So you had a massively indebted thing there that was under slightly because of the travel demand. This has still got a way to come back in terms of revenues coming in as travel normalises again, which I think it kind of eventually will, so there's room to run there, kind of just catching up in ways that you don't have to worry too much about growth. But it's kind of asset-light model means that its operating income comes in at 187% of its fixed assets, which makes it pretty near inflation-proof. It doesn't have to stick much into it. Higher costs don't really mean very much. Here's a thing that I found out today that I wasn't expecting to find out when I was looking at this stock. It's been buying back its shares between January 27th and February 1st. There's buybacks going on. I did not expect to see this. What I did expect to see was a 1.85% dividend, because stocks for February or Paul or whatever, you cannot not talk about the dividend, and I wanted to annoy Paul with my thoughts on its dividend mainly. Historically, these guys have run quite close to their coverage ratio. So a coverage ratio is a thing that I see dividend investors talking about a lot on Twitter. And basically what that is the amount of your net income that goes out the door via dividends again. So the general received thought is that the less of your net income your dividend takes up, the safer your dividend is. And I don't think Intercontinental fares terribly well in that. I think it's actually okay at the moment because it's had a couple of decent runs for net income, but they've tended to fly quite close to the wind on that, at least in the eye of dividend investors, who I think would mostly view that negatively. I view it positively, and here's why. I tend to think that if you had two companies, hard to compare these because they're not like with like, but if you have one company that's a manufacturing company and your earnings come in and you spend half of them on replacing machines or reinstalling factory equipment and that kind of thing, and then you dividend out the rest, you get sort of a coverage ratio of about 50% because you spent half of it from your net income and you dividend out the rest of it. And then you have a company like Intercontinental, which doesn't have any factories or indeed basically anything in the way of assets. Your earnings come in, you spend absolutely nothing on machines because you don't have any, and then you dividend out 90%. So here's the question then. Which one's a better one? I think it's fairly obviously the second one, the one that dividends out 90% of its income and not 50% of its income. Which one has a better coverage ratio? Well, obviously the first one. But coverage ratios, I think, get tangled up here when we compare net income to dividends going out, because if you have a company that can't dividend out its net income because it needs to use that for stuff, that will make its coverage ratio look a lot better, but that doesn't mean that there's room for manoeuvre there. It's not like if that net income goes down, well, they can suddenly stop maintaining their equipment and so on and say, well, that's okay, we'll just take it off that budget. Well, I mean, they might do if they're Intel, but they're not supposed to, is the general thought here. So I think this is a stock that I quite like from its asset-light sort of model. Doesn't take much capital to run, doesn't take much capital to grow, generates pretty good returns on its invested capital. Looks, I think, more expensive than it is. This is one where the PE is, I think, slightly misleading and has held up pretty well through the pandemic. There are other hotel brands around that I like, but I wanted a UK one. This is where this is what I would suggest to Paul if he were here, which he isn't. And maybe it's not relevant, because who knows where he is. Maybe he's just doing victory laps about being right about a stock.
Maybe. I was going to say, coverage ratio is one of those really interesting things. Like, whoever designed it got it wrong from the very start. You would think it would be better coverage ratio rather than looking at net income if it was looking at something like free cash flow.
I check this very, very carefully to do that, because when I think about dividends, I think about free cash flow, and because that's where they get paid from. But after I Googled this very carefully and looked on Investopedia and a couple of other places, they all seem to think it's about net income over, and if this is very much connected to the kind of hobby horse that you and I have of talking about PE ratios. One reason we don't like PE ratios very much is because the denominator can look weird at times. And if you think, look, these earnings look lower than they ought to be because there's a load of stuff going on that isn't really relevant to it or is misleading in some way, then you should think that the PE ratio is going to be misleading, and so is the dividend coverage ratio for anyone looking at it, because anything that has earnings as part of its equation is now going to look either higher or lower than it ought to.